All right, for the past couple of years, all we've heard about is AI's endless potential, right? But what happens when potential just doesn't cut it anymore? That's what we're diving into today. We're going to look past all the hype at something I'm calling the AI Productivity Mirage, and we're going to figure out why the old ways of measuring success are about to get tossed out the window as we head into 2026.
This quote right here, it absolutely nails the problem. You see, we've been in this phase where any kind of growth was celebrated. But that's changing. We're hitting a major turning point. The market is getting ready to stop handing out prizes for potential and start slapping penalties on inefficiency. So the question isn't how fast are you growing anymore. The real question is, are you actually making any money while you do it?
So to really get what's happening, you have to understand the sheer scale of this investment frenzy. And I mean, this isn't just another tech trend. This is a full-blown, modern-day gold rush. The amount of cash being poured in is, well, it's honestly breathtaking.
Okay, just look at this number for a second. $2.52 trillion. And let's be super clear, that's not the total value of the market. Nope, that's the projected global spending on AI in just 1 year, 2026. That's a 44% jump from the year before. It's all fueled by this seemingly bottomless pit of demand for AI in, well, pretty much everything.
And this slide shows you the physical reality behind all that digital ambition. We're not just talking about software and code. We're talking about massive, sprawling data centers, power grids that can handle the load, and all the cooling infrastructure. That $6.7 trillion figure, that's what's needed by 2030 just for the hardware. To give you some perspective, America's total capital spending across all industries in 2024 was around $8.3 trillion. So yeah, the scale here is just immense. This really sums it up perfectly. There's no exaggeration here. We are literally watching one of the largest and fastest capital buildouts in all of human history. It's like we're building a whole new layer of the global economy in real time. But with all this money flying around, it kind of begs the question,
where is all this money actually going? And more importantly, what is it producing? This is where things get really interesting and maybe a little worrying, because there's this huge disconnect between what's being spent and what's being earned.
This slide lays out the fundamental problem perfectly. On one side, you've got this absolute fire hose of money. We're talking hundreds of billions of dollars being poured into the AI machine. But on the other side, what's coming out is, well, it's more like a trickle of new revenue. Now, sure, some of this is just long-term investment. You have to build things out. But the gap is so huge, it makes you wonder, when is this spending actually going to turn into real, sustainable profit? Or will it ever? And this leads to a really interesting, kind of weird phenomenon called circular financing. Let me break it down. Imagine a giant chip company invests, say, $1 billion in some hot new AI startup. Great. But then that startup turns right around and uses a huge chunk of that cash to buy chips from the same company that just gave them the money. See what's happening? It looks like there's massive demand, right? Revenue's booming. But you have to ask, is this real organic growth, or is the industry just shuffling money around to pay itself?
You know, this isn't just a problem for the little guys. Even the undisputed king, OpenAI, really brings this issue into focus. They are the face of this revolution. They're making billions in revenue. And yet, they are on track to lose $8.5 billion. This kind of business model only works as long as investors are willing to keep writing checks, believing that someday it'll be profitable. But that belief, it doesn't last forever.
Which brings us right to the core idea here. 2026 is the year we think the market's patience is going to run out. It's the moment we hit what the tech folks call the trough of disillusionment. That's when all the hype fades away and people start looking at the cold, hard financial facts. You know, pretty much every game-changing technology goes through this. The internet did it, smartphones did it. It's kind of like the inevitable morning after a massive hype party. The easy venture capital money dries up and the market stops asking, is this cool, and starts demanding, does this make money? For AI, that moment of reckoning is coming up fast.
Now look, it's really easy to just shout .com bubble 2.0. And yeah, there are some scary similarities. Investors chasing a crazy new technology, valuations that are stretched thin. But, and this is a big but, there are some huge differences. Unlike back in 2000, the giants bankrolling this boom, Microsoft, Amazon, Google, are absolute cash-generating fortresses. A ton of this spending is coming straight from their own profits, not just from debt and VCs. That gives the whole ecosystem a much, much stronger foundation than we had back then.
Okay, so we've got this really complicated picture. How do we as investors, as observers, as just curious people, make sense of any of it? how do we pick out the businesses that are built to last from the ones that are just running on hype? Well, we need a new playbook, one that looks past just revenue growth and zeroes in on actual efficiency. So, how do we actually cut through all this noise? I want to introduce you to a really powerful metric, the EV to EBITDA ratio. You've probably heard of the PE ratio, but let's just put that aside for a minute. Think of EV to EBITDA as an X-ray of a company's real financial health. It takes the company's total value, and that includes its debt, and stacks it up against its raw operational profit, before all the fancy accounting and taxes get involved. Simply put, it tells you how much you're really paying for the part of the business that actually makes money.
And here's a super simple way to think about it. If you see a ratio under 10, that usually means a company might be undervalued. It could be a good deal. Somewhere between 10 and 20, that's pretty fairly priced. But once you get above 20, well, that's when the alarm bells should start ringing. You're in expensive territory. You're paying a huge premium for that company's earnings, and it's going to have to deliver some spectacular growth to make it worth it. It's a simple tool that helps keep your feet on the ground when everyone else has their head in the clouds.
And at the end of the day, this is the key. The story of AI is amazing. It's about changing the world, and it's super compelling. But the investors who really succeed, they're the ones who listen to the story, nod along, and then quietly go and check the hard numbers, like those EBITDA margins. They're looking for companies that aren't just spending on AI, but are actually using it to become more efficient and cut their costs.
Okay, so let's tie this all together. The point here isn't to be down on AI's potential. The tech revolution is 100% real. The goal is just to get us to think beyond that first wave of hype and start asking the smarter questions, the ones that help us figure out where the real lasting value is actually going to be.
I love this quote from Charlie Munger because it's the perfect guide for this moment. Pretty much everyone agrees AI is going to be huge. That's what you call first-level thinking. But second-level thinking asks, and then what? What are the consequences? Well, one consequence is insane valuations. Another is cutthroat competition. Asking, and then what, forces you to think about the long game, not just the big bang at the beginning.
And that really is the final question we should all be asking ourselves. It's not about who builds the coolest model or who gets the most media attention. In the long run, it's about who builds a durable, profitable business that can actually capture and hold on to a piece of this immense value that's being created. That's the real challenge and the opportunity as we look ahead to 2026 and beyond.